Hi viewers, thanks for tuning in to this episode of Bulls Interrupted. It's a series where we are trying to speak to some of the finest investing minds onto how do they approach interruptions in a bull run. I know currently it seems like everything is going hunky-dory, but frankly, if you look at the broader end of the spectrum, I don't think too many people will say that their portfolios are doing remarkably well. And somebody who understands portfolios, investing, and the Indian markets in great detail is our guest today on the show, Ramesh Damani. Ramesh, thanks so much for taking the time out.
Thanks, Neeraj. Nice to be with you as always.
Yeah, thank you so much. And you know, Ramesh, that whole thesis of doing this conversation was that how do people who've seen interruptions in what is arguably believed to be a secular bull market deal with it, because it's as much a mental issue as it is an issue of how your finances are backing you. How do you approach times like these?
It is, Neeraj, this episode was particularly painful compared to the others, either because A, I was ready for the previous ones, or B, we were in somewhat cash. So I go into this bearish phase, if you might call it, fully invested in markets and not knowing what hit me. And it wasn't a bear market because we look for signs for bear markets all the time. There's no extreme in the market in terms of, say, high interest rates, overdose of optimism, excess risk-taking. The market was fine in all those parameters, and as you will correctly note, that a bear market definition is 20% fall from the top, which never happened in the Nifty or the Sensex out there. So all the signs you look for an oncoming bear market weren't there. But the way the mid caps and small caps fell, it felt almost worse than a bear market. And while technically we didn't enter a bear market, we had to deal with it like we were in a bear market.
Yeah, I mean, and frankly, that was the thing, right, Ramesh? Almost everybody that you meet at an investor camp, for example, at the BQH events that we do, nobody was happy even when post-elections the market went up a little bit. Everybody said, yeah, 12,000 hai, but my portfolio is not showing that. Everybody's portfolios were bleeding, and probably even right now, even though the broader market has shown some signs, might still be under a lot of pain.
You know, Neeraj, as we always say that we live life forward, but we understand it backwards. I think some of the changes that happened almost precipitated the crisis. One was, of course, that you shrunk the economy by doing demonetization. And then, of course, the Insolvency and Bankruptcy Code. For the first time in India, managements that were negligent would go to zero or get wiped out of the equity. And that started a domino series of falls. I mean, if you recall the 80s and 90s, no company went to zero. You know, went to BIFR, the equity value held, it came back, and because you'd bought inflationary assets, they went back up in time. Now, for the first time, very well-known promoters, well-known assets were priced close to zero, which is a new experience that the market has not dealt with. Plus, you have the ongoing rigmarole of the market getting knocked out because of poor quality earnings. So what happened was the investors did, to use an old English saying, threw the baby out with the bathwater. They wanted to focus on the highest quality earnings, highest quality businesses, and they valued only those businesses, which are maybe 50 in this country, and threw the baby out with the bathwater and the rest. So even good mid-cap companies with good track records, good promoter franchises were knocked down to single-digit multiples and treated with a lot of disdain. So I think we are not ready for that. There's no way you can be ready for that. It's just what the market teaches you, which it taught us at this time that the market will do the reverse for the good, or the poor quality. It will throw what I said, the baby out with the bathwater. And that's a very painful lesson learned. With a lot of these stocks we've nursed and watched very carefully for years, and suddenly, despite paying dividends, despite paying taxes, despite having good corporate governance, this will knock down 50, 60%. So it's a very painful lesson that the market teaches us every time.
It does. Ramesh, my mind takes me back to the conversation that we had at the event in Mumbai 6 months, 7 months back, wherein you mentioned that the one gratifying thing about the stock markets is that after every winter there is a summer, and it inevitably comes about, and you got to be prepared for that. How did you, for example, you must have had some pain points in your portfolios as well. You would have had conviction in these names because of which you would have bought them, and maybe the earnings held out or otherwise, but maybe the valuations got damaged or whatever the case may have been. What do you, after so many years of market experience, tell yourself when such situations are happening?
Well, this is particularly, I mean, after 30 years in the market, you expect to be better prepared for something like this, and I wasn't. One of the few times you get caught with your pants down, it was disturbing. Am I getting old? Am I losing my reflexes? You go through all these things out there. The good news is that at the end of the day, great businesses will find a way to come back. Cream will rise to the top. So I'm not concerned about that. But in between, we had to go through a huge amount of a pain in the stocks we selected. Give you examples of companies that in the last 18 months have paid dividends of 50 rupees, 25 rupees, 12.5 rupees on a 500 rupees stock. So paid 80 rupees dividend, the stock's at 400 right now. So the market is not respecting almost anything other than the highest corporate governance. The truth though, Neeraj, as you say about capitalism, is that there is always summer coming. No matter how deep the winter is, the system won't work, capitalism won't work. Right. At some point, prices get discounted and the smart money scoops in and finds the bargains. And that the low base effect then kicks in, and again, you start getting rewarded for the things you make. And as you often read in newspaper headlines, that the time to buy is when there's maximum pessimism on the street. And I'll give you a case study for that. There couldn't be any worse headlines in the news press than what happened to our telecom companies. They were all destroyed over the last few weeks because of the headlines of adjusted gross revenues, the enormous amount of tax liabilities. And yet these stocks are up 20-30% in the next few weeks following that. So maybe we've reached the point of maximum pessimism, and maybe investors who made an error of optimism earlier are now making an error of pessimism. And the error of optimism maybe with the high quadrant, high value stocks, and the error of pessimism with the small cap, mid cap stocks. And if there's one iron rule of finance that I've learned, is that you always regress to the mean. So I think both won't hold. I think the high quality stocks will suffer periods of slowdown, and the low quality stocks, which will survive, will prosper over the next few years.